If Canada removes the tariffs on Chinese EVs, China will then remove tariffs on Canadian agricultural products?
A geopolitical shockwave has just hit Ottawa. Beijing has gone public with a striking offer. Remove the 100% tariff on Chinese electric vehicles, and in return, China will immediately lift all retaliatory tariffs on Canadian canola.
If Canada is ready to correct these practices, China will also respond accordingly.
The message was direct, not whispered behind closed doors. For Canada's farmers, small businesses, and consumers, this could be the most consequential trade decision in a generation. As of October 12, 2025, the question facing Prime Minister Mark Carney's government is whether Canada will keep mirroring Washington's trade wars or finally start negotiating in its own national interest. China's proposition comes at a moment when the Canadian agricultural sector is bleeding. Since early 2025,
I agree with what you said, that China's tariffs on Canadians' agricultural products are a countermeasure against the EV.
Beijing has imposed tariffs as high as 75.8% on Canadian canola seed, alongside 100% duties on canola oil and meal. Those measures have effectively slammed the door on a market worth nearly $5 billion in annual exports. Before the tariffs, China was Canada's second-largest canola buyer, absorbing more than 40% of total exports. The timing couldn't be worse. Across the prairies, storage bins are overflowing, prices have plummeted, and many farmers are on the brink of financial collapse. Rick White, president of the Canadian Canola Growers Association, described the crisis in blunt terms. We've got full bins, no buyers, and bills stacking up. Producers in Saskatchewan, Manitoba, and Alberta report that local elevators are filled to capacity, forcing them to hold unsold crops for months. Cash flow has dried up, and banks are tightening credit. Many growers now rely on government aid to stay afloat, and even that support can't offset the losses from a closed Chinese market. The pain runs deep, not only for farmers, but for thousands of small businesses, equipment dealers, truckers, seed suppliers that depend on the canola trade. This entire conflict started with Ottawa's decision to follow Washington's lead in slapping a 100% tariff on Chinese-made electric vehicles in late 2024. The measure mirrored the United States' own protectionist move, justified by claims of illegal subsidies and national security concerns. Yet for Canada, the effects have been largely symbolic. The tariff has not created a domestic EV manufacturing boom, nor has it protected Canadian consumers. Instead, it has shut out affordable Chinese EVs that could have sold for around $35,000 to $40,000, tens of thousands less than comparable models in North America. By aligning with U.S. policy, Canada sacrificed access to competitively priced clean technology while gaining nothing tangible in return. In contrast, the United Kingdom, Australia, and much of Europe have welcomed Chinese EVs, giving consumers low-cost, high-quality options and boosting green vehicle adoption rates. In Britain, Chinese brands like BYD and MG have become bestsellers, proving that the vehicles themselves are not the issue, it's the politics behind them. Ottawa's insistence on mirroring Washington's tariffs has now left Canada with inflated car prices, struggling farmers, and a widening trade deficit. Beijing's retaliation targeted Canada's agricultural heart deliberately and effectively, striking at the sector least equipped to endure prolonged market exclusion. During a September 2025 delegation to Beijing, Prime Minister Mark Carney met with Chinese officials alongside Saskatchewan Premier Scott Moe. The talks were described as constructive, but no breakthrough emerged. Carney reiterated Canada's desire for fair trade, while China made clear that the canola dispute began not in Beijing, but in Ottawa, when Canada chose to impose the 100% EV tariff.
And if the EV tariffs are removed, then China will also remove the tariffs on the relevant products of Canada.
The Chinese position was simple: reciprocity. remove the tariff barrier on electric vehicles, and they would immediately lift restrictions on canola imports. The offer was not presented as a threat, but as an invitation to reset relations on practical grounds. Back home, pressure on the Carney government has been mounting. According to a recent national poll, 57% of Canadians support reducing or removing the EV tariff if it means restoring canola exports. Only 24% oppose the idea. In the Prairie provinces, where the agricultural economy dominates, the numbers are even more decisive. 68% in Saskatchewan, 61% in Manitoba, and 60% in Alberta want Ottawa to take the deal. Politically, the issue cuts across party lines. A majority of Liberal, NDP, and even Conservative voters say it's time to prioritize Canadian interests over foreign loyalty. Premier Scott Moe summed it up best. We cannot keep losing billions for the sake of symbolism. Farmers can't pay their bills with political loyalty. Meanwhile, Canada's automotive sector is quietly warning of its own struggles. Flavio Volpe, head of the Automotive Parts Manufacturers Association, noted that automakers and suppliers are facing liquidity pressures amid ongoing trade uncertainty. The 100% EV tariff has closed the door on potential partnerships that could have brought Chinese investment into Canada's manufacturing base. Smaller EV component firms say they would welcome joint ventures with Chinese producers, provided Ottawa establishes clear rules to protect domestic capacity. As one Quebec-based entrepreneur put it, we don't need to surrender our market, we need to make it work for us. Let them build here, hire our workers, and use our aluminum and lithium. That's how you win. This would not only restore balance with China, but also create jobs and modernize Canada's auto industry. Critics, however, warned that accepting Beijing's offer could be politically risky. Some fear that opening the market to Chinese EVs would flood Canada with cheap imports and threaten domestic innovation. Others argue it might be perceived as a concession to China, undermining Canada's alignment with Western allies. Yet, even among skeptics, there is acknowledgement that the current policy is untenable. Canadian farmers are paying the price for a trade war they didn't start and cannot win. Following Washington's lead has repeatedly cost Canada dearly, from steel and aluminum tariffs to softwood lumber disputes. And each time, it's Canadian workers who take the hit. Economists note that removing the EV tariff wouldn't be an act of weakness, but one of sovereignty. It would show that Ottawa can act in Canada's interests without waiting for American permission. It would also reflect economic realism. The Chinese EV industry is now the most advanced and affordable in the world, with production costs 30% lower than most Western automakers. Keeping them out of Canada does nothing to protect consumers or industry. It simply denies Canadians access to cleaner, cheaper technology. The proposal could also be structured in phases. In the first 6 months, Canada could suspend the EV tariff for a limited number of models under strict import quotas. China would reciprocate by suspending its canola duties. In the second phase, Chinese EV makers could partner with Canadian firms to build or assemble vehicles domestically, creating jobs and safeguarding technology transfer. By the third phase, full tariff normalization could occur, backed by a bilateral framework ensuring transparency and dispute resolution. Such an arrangement would turn a trade standoff into a balanced recovery. Beyond economics, the decision carries symbolic weight. For decades, Canada's trade identity has been defined by its dependence on the U.S. market. But as Washington's policies grow increasingly protectionist, Canada's future depends on diversifying its alliances. China needs Canadian resources, energy, minerals, food, just as Canada needs diversified export destinations. Both countries stand to gain from cooperation rooted in mutual benefit, not blind alignment. Mark Carney himself has said that Canada must balance competition with cooperation in an era of global realignment. The EV canola deal is precisely that opportunity. Still, Ottawa hesitates. The fear of upsetting Washington lingers, especially as Donald Trump's second term intensifies tariff-driven nationalism across North America. Yet Canada must recognize that the U.S. has never hesitated to act unilaterally when it serves its interests. When the U.S. imposed tariffs on Canadian steel, aluminum, and lumber, it offered no exemptions, no compensation, and no apology. Why then should Canada continue paying the cost of someone else's trade war? Across the prairies, frustration is boiling over. Farmers' groups are organizing demonstrations outside Parliament demanding immediate action. They point to the hypocrisy of subsidizing agricultural losses while blocking the very trade relief that could end the crisis. "We don't need another bailout," said one Alberta grower. "We need our markets back." The message resonates with many Canadians who see the current policy as political posturing, detached from economic reality. If Ottawa takes the deal, it could immediately relieve the pressure on farmers, lower EV prices for consumers, and restore stability to Canada's trade balance. It would send a powerful signal that Canada can negotiate as a sovereign nation, not a shadow of Washington's agenda. If it refuses, the costs will deepen. More bankrupt farms, higher consumer prices, and a growing perception that Canada lacks the courage to lead its own economic destiny. This moment is bigger than canola or cars. It is a test of whether Canada can stand on its own feet in a world defined by superpower rivalries. China's offer is not charity, it's a recognition of Canada's leverage. The world's second-largest economy wants access to our minerals and technology. We want access to their markets and affordable green innovation. The logic is straightforward, the benefits mutual. What's missing is the political will to say yes. Every time Canada has tied its trade policy to Washington's mood swings, it has lost. The EV tariff crisis offers a rare chance to change that pattern, to act not as a follower, but as a nation shaping its own economic future. As one Saskatchewan farmer put it simply, "We've played by someone else's rules long enough. It's time to play for ourselves." In the end, this is more than a trade dispute. It's a defining moment for Canada's independence. Will Ottawa seize the chance to chart its own course, or remain bound to policies made in Washington? Accepting China's offer could revive the prairies, lower costs for families, and prove that Canada can stand as a sovereign power in a divided world. Refusing it means more lost harvests, higher prices, and a future dictated by someone else's agenda. The world is watching, and history will remember which path Canada chooses.
Condo sales in some major Canadian markets are continuing to drop to lows not seen in decades.
New construction of homes crater in Ontario and British Columbia, really lowest points in multiple decades.
The number of homes being sold across the country is slowing down. New home sales in the Greater Toronto Area declined by 72% year over year.
Uncertainty over U.S. tariffs appears to be keeping buyers away from the real estate market.
We saw a number of layoffs within the housing industry, a key economic driver of the economy across the country.
For years, Toronto's skyline was a monument to endless growth, a city where cranes never stopped turning and every pre-construction ad promised wealth. But as of October 10, 2025, that dream has turned into a slow-motion financial wreck. Home values have plunged nearly 25%, erasing more wealth than the entire 1990s bust. And the pain is spreading from developers' boardrooms to suburban kitchen tables. What began as a policy mistake has become a generational reckoning, the collapse of Canada's biggest housing bubble. Toronto's housing market didn't implode overnight. It was built on easy credit and political complacency. Between 2020 and 2021, cheap money from near-zero interest rates sent buyers into a frenzy. Families, investors, and foreign buyers scrambled to grab anything with four walls. Bidding wars erupted even for tiny condos, and average home prices shot past 1.3 million Canadian dollars. Politicians promised more supply, rolling out the More Homes Built Faster program and cutting red tape for developers. But instead of creating affordability, it fueled speculation. By 2022, internal memos from Ontario's housing ministry already warned that prices were out of control, yet officials ignored the signals. When the Bank of Canada finally hiked rates to cool inflation, it hit housing like a sledgehammer. In less than 2 years, mortgage rates tripled. Borrowers who once locked in 2% loans suddenly faced renewals at 4 to 5.5%. According to the Bank of Canada, nearly 60% of Canadian mortgages will renew by the end of 2026, exposing families to payment shocks of 10 to 15%. A couple in Oshawa paying $3,000 a month in 2021 could now be facing $3,300 or $3,400 without any raise in income. Across the Greater Toronto Area, thousands are extending amortizations to 30 or 35 years or listing their homes before default. Mortgage brokers report a sharp rise in distress calls as borrowers discovered that the math simply doesn't work anymore. The data confirmed the unraveling. Active listings in September 2025 climbed to nearly 29,400, a multi-year high. The sales-to-new listings ratio plunged to 29%, meaning for every 3 homes hitting the market, only 1 sells. That's textbook buyer market territory. Condos, once the hottest ticket, are now bleeding value fastest. Average resale condo prices are down 5.9% year over year, while per square foot prices in downtown towers have fallen from 1,400 Canadian dollars to 800, a 40% crash. For ordinary investors who bought a single unit as a retirement plan, that's a $200,000 to $300,000 loss on paper. Developers aren't immune. Housing starts in Toronto collapsed 44% in the first half of 2025, the steepest decline since 1998. Condo starts plunged 60% as projects were halted mid-construction. Big names like Grand Central Mimico and the View Beach residences have entered receivership, leaving half-finished towers behind chain-link fences. The Canada Mortgage and Housing Corporation calls it the lowest building activity in 3 decades. Industry analysts warn that today's glut will become tomorrow's shortage. Tens of thousands of units will flood the market this year, but few new projects will break ground for years to come. Inside government, panic is visible. Confidential cabinet memos leaked Queen's Park warn of public confidence at risk as prices fall and headlines mount. Premier Doug Ford faces growing criticism that his housing plan favored developers over ordinary Ontarians. The Auditor General's report on the Greenbelt scandal already accused the government of opaque decision-making and preferential treatment. Now, critics say those same policies helped inflate a bubble that ordinary families must pay for. Ford defends his approach, insisting building faster is still the only answer, but even allies admit the province underestimated the scale of the downturn. In Toronto City Hall, Mayor Olivia Cho has announced $975 million Canadian dollars in spending to build 14,000 affordable units, plus incentives for sixplexes and laneway homes. Yet many economists argue these measures barely scratch the surface. Urban planner Charisse Berta of Toronto Metropolitan University says bluntly, "We built too many investor condos and not enough homes for people who actually live here." The human stories behind the data are grim. A young couple who bought an $850,000 condo in 2021 now see it worth $660,000. Their renewal letter shows a payment jump they can't handle. Selling would mean locking in a 6-figure loss. Staying means watching their paychecks vanish into the bank's account. One floor above them, a retired teacher who used a home equity line to help her daughter buy in Whitby now owes more than her property is worth. "I can't sleep," she admits. "I worked 40 years and did everything right." For small businesses tied to real estate, the fallout is devastating. Construction suppliers across the Greater Toronto Area report order volumes down 30 to 40%. A framing contractor in Brampton says he's laying off workers weekly. No new projects, no jobs. Real estate agents are quitting in droves. According to the Toronto Regional Real Estate Board, monthly transactions are 21% lower than a year ago. "I used to close 5 deals a month," says one agent. "Now I'm lucky to get 1. Mortgage brokers echo the same despair. People are desperate to refinance, but with rates and falling appraisals, most don't qualify, says veteran broker Ron Butler. Meanwhile, investors who loaded up on multiple condos during the boom are trapped in negative cash flow. Rents have flattened while payments soar, and resale buyers are scarce. Online forums are filled with posts from landlords trying to offload units before the math stops working. Institutional buyers and private equity funds are circling, hunting for distressed assets under $700,000. Economists warn this could further tilt ownership away from families toward corporate landlords. The broader economy feels the squeeze. Consumer spending is falling as households divert income to higher mortgage payments. Banks are tightening construction credit, performing internal stress tests on condo portfolios, and quietly freezing new development loans. Economists at RBC and CIBC expect Ontario's GDP growth to fall below 1% in 2026 if housing continues dragging investment and employment. Even with the Bank of Canada's recent rate cut to 2.5%, relief is slow. It cannot offset the renewal shocks already baked in. Some signs of stabilization appear on paper. In September 2025, Greater Toronto home sales edged up 2% from August to 5,765 units. Yet prices still slipped another 0.5%. RBC calls it a low-key fall, where modest activity masks deep structural weakness. Real estate analyst Daniel Foch argues the bottom hasn't arrived. Every small rally we've seen this year fades once new listings pile in again, he says. There's still too much supply chasing too few qualified buyers. Experts are split on how far the market can fall. Bearish forecasts suggest another 10 to 15% decline through 2026 as renewals peak. Others see limited downside if the Bank of Canada keeps cutting rates. But everyone agrees the boom psychology is dead. The idea that real estate only goes up has vanished. A survey by the University of Guelph found 63% of Ontarians now believe housing is a high-risk investment, compared with 22% just 3 years ago. That shift in sentiment could reshape Canadian wealth habits for an entire generation. On the political front, federal officials are scrambling to appear proactive. Ottawa's $6 billion Housing Accelerator Fund is meant to push municipalities to rezone for higher density, yet critics call it too little, too slow. Finance Minister Chrystia Freeland insists a soft landing is still achievable, pointing to strong immigration and employment. But immigration itself is under scrutiny. Population growth outpaced new housing starts 3-to-1 in 2024, worsening affordability. Even the Canada Mortgage and Housing Corporation warns that by 2030, the country will need 3.5 million additional homes, a goal it calls mathematically impossible under current trends.
Economists worry about contagion beyond Toronto. Cities like Vancouver, Calgary, and Ottawa are already showing early signs of stress. In Calgary, benchmark prices have flattened after a 20% surge last year. Vancouver's detached homes are down 9% since 2022. Nationally, CREA's September report showed sales up slightly, but prices down 2.1% month over month, the sharpest decline since 2018. For now, Toronto remains ground zero. The pipeline of half-built condos means short-term oversupply will persist into 2026, even as new construction collapses. After that, a shortage could return, creating yet another cycle of volatility. Economist Robert Hogue at RBC summarizes it simply: Toronto built for investors, not residents. Now it's paying the price. The story of this crash isn't just financial, it's cultural. A generation raised to see home ownership as security now faces a different reality, that houses can lose value, and that debt can outlive optimism. Across the city, conversations once filled with renovation plans have turned into talks about survival. Some neighborhoods, like Scarborough's newer suburbs, are dotted with for-sale signs and half-empty open houses. Downtown, glass towers that once symbolized ambition now flicker at night with rows of dark windows. Economists say recovery will depend on policy discipline and time. Lower interest rates might stabilize prices,
But without income growth or affordable construction, any rebound could be temporary. Developers warn that labor shortages and material costs make it impossible to build truly affordable housing even if financing improves. Meanwhile, renters face their own crisis, with average Greater Toronto rents still 18% higher than pre-pandemic, despite falling demand for condos. As 2025 ends, the questions grow louder. How far will prices fall? How many families will lose their homes? Will developers survive another year of stalled sales? No one has clear answers, but the message from analysts, lenders, and homeowners is the same. Toronto's market is undergoing its most painful correction in modern history. The easy money era is over, and the illusion of unstoppable growth has shattered. For the average Canadian, the lesson is harsh but overdue. When speculation replaces fundamentals, reality always wins. Toronto is now living that truth in real time. A city built on borrowed confidence, finally learning what happens when the bill comes due.